All right, continued reading of the CFA Level 1 program curriculum, now on reading 12 on hypothesis testing. The learning outcomes for this chapter includes define a hypothesis, describes the steps of hypothesis testing, and describe the inputs that choice of the null and the alternative hypothesis, distinguish between one-tailed and two-tailed tests of hypothesis, explain a test statistics, type 1, type 2 errors, significance level, and how significance levels are used in hypothesis testing, explain a decision rule or power of a test, and the relationship between confidence intervals and hypothesis testing, distinguish between a statistical result and an economically meaningful result, explain and interpret the p-value as it's relative to hypothesis testing, identify the appropriate test statistics and input that the results for hypothesis tests concerning the population mean of both large and small samples, with the population is normally or approximately normally distributed and the variance is 1 known or 2 unknown. Identify the appropriate test statistics and interpret the results for a hypothesis test concerning the equality of the population mean of two at least approximately normal distributed population based on independent random samples with 1 equal or 2 unequal assumed variance. Okay. Oh, we have continued. Identify the appropriate test statistic and interpret the result from a hypothesis test concerning the mean difference of 2 normally distributed populations. Identify the appropriate test statistics and interpret the results for a hypothesis test concerning 1, the variance of a normally distributed population, and 2, the equality of the variance of 2 normally distributed populations based on 2 independent random samples. Distinguish between parametric and non-parametric tests and describe situations in which we use the use of non-parametric tests may be appropriate. Introductions. Analysts often convert competing ideas about how financial markets work. Some of these ideas developed through personal research or experience with markets. Others come from interactions with colleagues. And many other appear in the professional literature on finance and investment in general. How can an analyst decide whether statements about the financial world are probably true or false? When we reduce an idea or assertion to a definite statement about the value of a quantity, such as the underlying or population mean, the idea becomes a statistically testable statement or hypothesis. The analyst must want to explore questions such as the following. Is the underlying mean return on the mutual fund different from the underlying return of the benchmark? Did the volatility of return on the stock change after the stock was added to a stock market index? Are the security bid-ask spread related to the number of dealers making a market in the security? Do data from a national bond market support the predictions of an economic theory about the term structure of interest rates, the relationship between yield and maturity? To address these questions, we use the concept and tools of hypothesis testing. Hypothesis testing is a statistical inference, the process of making judgments about a larger group, a population, on the basis of a smaller, actually observable sample. The concept of the tool of hypothesis testing provides objective means to gauge whether available evidence supporting the hypothesis. After statistical tests of After statistical tests of a hypothesis, we should have a clear idea of the probability that a hypothesis is true or not. Although our conclusion always stops short of certainty, hypothesis testing is a powerful tool in the advancement of investment knowledge and science. As Robert L. Kahn of the Institute of Social Research and Albert, Michigan has written, the meal of science grinds only when hypothesis and data in continuous and abrasive contact. The main emphasis of this reading are the frameworks of hypothesis testing and tests concerning the mean and variance, two quantities frequently used in investments. We give an overview of the procedure of hypothesis testing in the next section. We then address testing hypothesis about the mean and hypothesis about the difference between mean. In the fourth section of this reading, we address testing hypothesis about a single variance of hypothesis about the difference between variances. We ended the reading with an overview of some other important issues and techniques in statistical inference. Hypothesis testing, as we have mentioned, is part of a branch of statistics known as statistical inference. Traditionally, this field of statistical inference has two subdivisions: estimation and hypothesis testing. Estimation addresses the question, what is the parameter, e.g. the population mean's value? The answer is in the form of a confidence interval built around a point estimate. Take the case of the mean. We build a confidence interval for a population mean around the sample mean at a point estimate. For the sake of some specificity, suppose the sample mean is 50 and a 95% confidence interval for the population 50 plus or minus 10. The confidence interval runs from 40 to 60. If this confidence interval has been properly constructed, there is a 95% probability that the interval from 40 to 90 contains the population's mean value. The second branch of the statistical inference, hypothesis testing, has a somewhat different focus. A hypothesis testing question is the value of the parameter, say the population mean, 45? Or some other specific value. The assertion the population mean is 45 is a hypothesis. A hypothesis is defined as a statement about one or more populations. This section focuses on the concept of hypothesis testing. The process of hypothesis testing is part of a rigorous approach. Is approach to acquiring knowledge known as the scientific method. The scientific method starts with observation and the formulation of theory and organize and explain observations. We judge the correctness of the theory by its ability to make accurate predictions. For example, it predicts the result of new observations. If the predictions are correct, for example, to predict the results of new observations, if the predictions are correct, we continue to maintain the theory as a possibility correct explanation of our observations. When risk play a role in the outcomes of observations, as in finance, we can only try to make unbiased, probability-based judgment about whether the new data supports the predictions. Statistical hypothesis testing fills that key role of testing hypothesis. When chance plays a role in an analyst's day-to-day work, he may address questions to which he may give answer of varying quality. When an analyst correctly formulates the question into a testable hypothesis and carries out the report on a hypothesis test, he provides an element of support and carries out the report on a hypothesis test. He has provided an element of support to his answer consistent with the standards of scientific method. Of course, the analyst's logic, economic reasoning, information sources, and perhaps other factors also plays a role in our assessment of the answer's quality. We organize this introduction of hypothesis testing around the following list of 7 steps. 1 step in hypothesis testing. The step in testing a hypothesis are follows. 1, stating the hypothesis. 2, identifying the appropriate test statistic and its probability distributions. 3, specify the significance level. 4, stating the decision rule. 5, collecting the data and calculating the test statistic. 6, making the statistical decision. 7, making the economic or investment decision. We will explain each of these steps using an illustration of hypothesis testing, a test concerning the sign of the risk premium on Canadian stocks. The steps above constitute a traditional approach of hypothesis testing. We will end the section with a frequently used alternative to those steps, the p-value approach. The first step in hypothesis testing is the stating the hypothesis. We always state 2 hypotheses. That's a weird word. the null hypothesis or no designated as H0 and the alternative hypothesis designated as HA. Definition of the null hypothesis. The null hypothesis is the hypothesis to be tested. For example, we can hypothesize that the population mean risk premium for Canadian equities is less than or equal to 0. That's a good that's a hypothesis I guess you could have. The null hypothesis is a proposition that is considered true unless the sample we use to conduct the hypothesis test gives convincing evidence that the null hypothesis is false. When such evidence is presented, we are led to alternative hypothesis. Definition of alternative hypothesis. An alternative hypothesis is that hypothesis accepted when the null hypothesis is rejected. Our alternative hypothesis is the population mean risk premium of Canadian equities is greater than 0. Suppose our question concerns the value of a population parameter 0 in relation to one possible value of the parameter 0, theta 0. These are read respectively data and theta sub 0. Okay, theta sub 0. It's a Greek letter. Examples of population parameter includes population mean, mu, and population variance, standard deviation squared. We can formulate 3 different sets of hypotheses, which are labeled according to the assertion made by alternative hypothesis. Formulating of hypothesis, we can formulate the null and alternative hypothesis in 3 different ways. So the null hypothesis is equal to theta sub 0 when it is this is the formulating of hypothesis. If Canadian in our Canadian example of theta equals mu sub RP that represents the population mean risk premium of Canadian equities. Also, theta sub 0 equals 0, and we are using the second of the above 3 formulations. The first formulation is a two-sided hypothesis or two-tailed hypothesis test. We reject the no in favor of the alternative if the evidence indicates that the population parameter is either smaller or larger to theta 0. In contrast, formulations 2 and 3 are each a one-sided hypothesis test or one-tailed hypothesis test. For formulations 2 and 3, we reject the no only if the evidence indicates that the population parameter is respectively greater than or less than theta sub 0. The alternative hypothesis has one side. Notice that in each case above, we state the no and alternative hypothesis such that they account for all possible values of the parameter. With formulation 1, for example, the parameter is either equal to the hypothesized values of theta sub 0 under the no hypothesis or not equal to the hypothesized value theta sub 0. Under the alternative hypothesis, these two statements logically exhaust all possible values of the parameter. Despite the ways to formulate hypothesis, we always conduct a test of the null hypothesis as the point of the equity, as the point of equality. Theta equals theta sub 0. Whether the no is h sub 0 equals theta sub 0, or otherwise, we actually test theta equals theta 0. The reasoning is straightforward. Suppose the hypothesis value of the parameter is 5, considered h sub 0, or the no hypothesis to be equal to theta is lesser or equal to 5, with a greater than alternative hypothesis of h is greater than 5. No more or equal, just greater than 5. If we have enough evidence to reject the null hypothesis of theta equals 5 in favor of the theta as greater than 5, we definitely also have evidence to reject the hypothesis of the parameter that theta is some smaller value such as 4.5 or 4. To review, the calculation to test the null hypothesis is the same for all the 3 formulations. What is different for the 3 formulations we will see shortly is how the calculation is evaluated to decide whether or not to reject the no. How do we choose the no and alternative hypothesis? Probably most common are not equal to alternative hypothesis. We rejected no because the evidence indicates that the parameters is either larger or smaller than theta sub 0. Sometimes, however, we must have a suspected or hoped for condition for which we want to find supportive evidence. In that case, we can formulate the alternative hypothesis as the statement that the condition is true. The no hypothesis that we test in this statement of the conditions is not true. If the evidence rejects the no and accepts the alternative, we have a statistically confirmed what we thought was true. For example, economic theory suggests that investors require positive risk premiums on stocks, or risk premiums defined as the expected return on the stock minus the risk-free rate, following the principle of stating the alternative of hope for conditions. We formulate the following hypothesis: the population mean risk premium on Canadian stocks is less than or equal to 0. Or the alternative hypothesis of the population mean risk premium on Canadian stocks is positive. Note that greater than and less than alternative hypothesis reflects the belief of the researcher more strongly than the not equal to alternative hypothesis. To emphasize an attitude of neutrality, the researcher may sometimes select a not equal to alternative hypothesis when a one-step alternative hypothesis is also reasonable. The second step in hypothesis testing is identifying the appropriate test statistic and its probability distribution. Definition of test statistic. A test statistic is a quantity calculating based on a sample whose value is the basis for deciding whether or not to reject the no hypothesis. The focal point of our statistical decision is the value of the test statistic. Frequently in all the cases that we examine in this reading, the test statistic has that form: test statistic equals sample statistic minus value of the population parameter under the no hypothesis, divided all this value by the standard error of the sample statistic. For a risk premium example, the population parameter of interest is the population mean risk premium, or the mu RP, the mu of the risk premium. We label the hypothesized value of the population mean under the no hypothesis as mu 0. Restating the hypothesis using the symbols, we test the no hypothesis as this versus this value. However, because under the no we are testing mu sub 0 equals 0, we write the formulas as such. The sample mean provides an estimate of the population mean. Therefore, we can use the sample mean risk premium calculated for the historical data x bar sub RP as the sample statistic in equation 1. The standard deviation of the sample statistic, known as the standard error of the statistic, is the denominator of equation 1. For this example, the sample statistic is a sample mean. For the sample mean x bar calculated from a sample generated by the population with standard deviation with this symbol. The standard error is given by one of two expressions. Standard deviation multiplied by x bar equals standard deviation divided by the square root of n. When we know that standard deviation, the population standard deviation, or this, when we know, okay. We have identified a test statistic to test the no hypothesis. What probability distribution does it follow when we encounter 4 distributions for test statistics in this reading? The t distribution for a t-test, the standard normal or z distribution for a z-test, the chi-square, the x-square distribution for the chi-square test, and the f distribution for an f-test. We will discuss in the details later, but assume we can conduct a z-test based on the central limit theorem because our Canadian sample has many observations. To summarize, the test statistic for the hypothesis test concerning the mean risk premium is x bar sub RP divided by SX bar. We can conduct a z-test because we can possibly assume that the test statistics follow a standard normal distribution. The third step The third step of hypothesis testing is specifying the significance level. When a test statistic has been calculated, two actions are possible. One, we reject the null hypothesis, or two, we do not reject the null hypothesis. The action we take is based on comparing the calculation test statistic to the specified possible value or values. The comparison value we choose are based on the level of significance selected. The level of significance reflects how much sample evidence we required to reject the null, analogous to its counterpart of the court of law. The required standard of proof can change according to the nature of the hypothesis and the seriousness of the consequence of making a mistake. There are four possible outcomes when we test a null hypothesis. One, reject a false null hypothesis. This is a correct decision. Two, we reject a true null hypothesis. This is a type 1 error. Three, we do not reject a false null hypothesis. This is a type 2 error. And we do not reject a true null hypothesis. This is a correct decision. We illustrate these outcomes in table 1. So here's table 1. When we make a decision in a hypothesis test, we run the risk of making either a type 1 or type 2 error. These are mutually exclusive errors. If we mistakenly reject a no, we can only be making a type 1 error. If we mistakenly fail to reject a no, then we can making a type 2 error. The probability of type 1 error is testing a hypothesis is denoted by the Greek letter alpha. The probability is also known as the level of significance of the test. For example, a level of significance is 0.05 for a test may mean that a 5% probability of rejecting a true null hypothesis. The probability of type 2 error is denoted by the Greek letter beta. Controlling the probabilities of the two types of errors involves a trade-off, all else equal. If we decrease the population of type 1 error by specifying a smaller significance level, say 0.01 rather than 0.05, we increase the probability of making a type 2 error because we will reject the no less frequently, including when it's false. The only way to reduce the probabilities of both types of errors simultaneously is to increase the sample size n. Quantifying the trade-off between the two types of errors in practice is usually impossible because the probability of type 2 errors is itself hard to quantify. Considered the null hypothesis of theta is lesser or equal to 5 versus theta is greater than 5, because every true value of theta greater than 5 makes the null hypothesis fake. Each value of 0 greater than 5 has a difference of beta. Type 2 error probability is in contrast is significant to us type 1 error probability for theta equals 5. The point at which we conduct the test of the null hypothesis. Thus, in general, we specify only alpha and the probability of type 1 error when we conduct a hypothesis test. Whereas the significance level of a test is the probability of increasingly rejecting the no and power of the transcript. When more than one test statistic is available to conduct the hypothesis test, we should prefer the more powerful, all else equal. To summarize, the standard approach to hypothesis testing involves specifying a level of significance. Probability of type 1 error only it is most appropriate to specify its significance level prior to calculating the test statistics. If we specify if after calculating the test statistic, we may be influenced by the results of the calculations, which distract from the objectives of the test. We can use the three conventional significance level to conduct a hypothesis test: 0.1, 0.05, and 0.01.
qualitatively, if we can reject a null hypothesis at the 0.0 to the 0.1 level of significance, we have some evidence that a null hypothesis is fake. If we can reject a null hypothesis at its 0.05 level, we have a strong evidence that the null hypothesis is false. And if we can reject at a hypothesis level of 0.05, 0.01, we have a very strong evidence that the null hypothesis is false. For the risk premium example, we will simply we will specify of 0.05 significance level. The fourth step in hypothesis testing is starting the decision rule, the general principle in simple stated. When we test the null hypothesis, if we find that the calculating value of the test statistic is more extreme than a given value or values determined by the specified level of significance, we have a statistically significant. We say the result is significantly significant. Otherwise, we do not reject the null hypothesis, and we say the result is not satisfactorily significant. Definition of rejecting point or critical value. These are just intuitive stuff. Here's a graph. Here's another graph. And here is reading 11 part 3. So I do hope this reading has been helpful, and I hope to see you guys in future readings where we'll be going on continuing on the CFA Level 1 program reading. Without further ado, goodbye. Okay, continued reading of the CFA Level 1 program curriculum. Reading 12. Part 3, hypothesis tests concerning the mean. Hypothesis tests concerning the mean are among the most common in practice. In this section, we discuss such tests for several distinct type of problems, and one type discussed in section 3.1, we test whether the population mean of a single population is equal to or greater than or less than some hypothesized value. Then in section 3.2 and 3.3, we address inference on means based on two samples. Is an observed difference between two sample mean due to the chance or difference underlying population mean? When we have two random samples that are independent of each other, no relationship exists between the measurements in one sample and the measurements in the other. The technique of section 3.2 applies when the sample are dependent. The methods of section 3.3 are appropriate. 3.1 test concerning a single mean. An analyst who wants to test a hypothesis concerning the value of an underlying or population mean will conduct a t-test. In the great majority of cases, a t-test is a hypothesis test using a t-statistic that follows a t-distribution. The t-distribution is a probability distribution defined by a single parameter known as a degree of freedom. Each value of degrees of freedoms define one distribution in the family of distributions. The t-distribution is closely related to the standard normal distribution. Like the standard normal distribution, a t-distribution is symmetrical with a mean of 0. However, the t-distribution is more spread out. It has a standard deviation greater than 1 compared to 1 for the standard normal, and more probability for outcomes distant from the mean. It has a fatter tail, and the standard normal distribution, as the number of degrees of freedom increases with the sample size, the spread decreases, and the t-distribution approaches the standard normal distribution as a limit. Why is the t-distribution the focus of the hypothesis test? In this section, in practice, investment analysts need to estimate the population standard deviation by calculating a sample standard deviation. That is, the population variance or standard deviation is unknown. For hypothesis tests concerning the population mean of a normally distributed population with unknown variance, the theoretically correct test statistic is the t-statistic with a normal distribution. Does not describe the population. The the test is robust and moderate departure from normality, except the outliers and strong skewedness. When we have large samples, departure of the underlying distribution from the normal are of increasing less concern. The sample mean is approximately normally distributed in large samples according to the central limit theorem. Whatever the distribution describing the population, in general, a sample size of 30 or more usually can be treated as a large sample, and a sample size of 29 or less is treated as a small sample. Test statistic for hypothesis test of the population mean. The practice case, population variance unknown. If a population sample has unknown variance and either of the conditions below holds, the sample is large, or the sample is small but the population sample is normally distributed or approximately normally distributed. Then the test statistic for hypothesis test concerning the single sample population mean, mu is equal to this formula, where these are what the variables mean. The denominator of the t statistic is an estimate of the sample mean standard error of s sub x bar equals s divided by n square rooted, or to the power of 1/2. In example 1, because the sample size is small, the test is called a small sample test concerning the population mean. Example 1, risk and return characteristics of an equity mutual fund. If you are analyzing a Sender equity fund, a mid-cap growth fund that has been in existence for 24 months, during this period, it has achieved a mean monthly return of 1.5% with a sample standard deviation of monthly returns of 3.6%. Given its level of symmetric market risk, and according to a pricing model, the mutual fund was expected to have earned 1.1% mean monthly return during that time period, assuming returns are normally distributed. Are the actual results consistent with the underlying or population mean monthly return of 1.1%? Formulate no and alternative hypothesis consistent with the verbal description of the research goal. Identify the test statistic of conducting a test of hypothesis in part 1. Identify the rejection point or points for the hypothesis tested in part 1 at 0.1 level of significance. Determine whether the no hypothesis is rejected or not rejected at the 0.1 level of significance. Use the table in the back of the book. Solution to 1. We have a not equal to alternative hypothesis where mu is underlying mean return of the Sender equity fund. So both of them added together will be the universal data set. So solution to 2, because the population variance is not known, we use a t test with 42 minus 1 equals 23 degrees of freedom. Solution to 3, because this is a two-tailed test, we have to reject point this. In the table for the t distribution, we look across the row for 23 degrees of freedom to 0.05 column to find 1.714, and the two rejection points for the two side tests are 1.714 and negative 1.714. We will reject the null if we find that t is greater than or t is lesser than this number. Solution to 4, we just plug it into the formula and get this result. Because 0.544 does not satisfy either t is greater or t is lesser than these two values, we do not reject the no hypothesis. The confidence interval approaches provides another perspective. In the hypothesis test, the theoretically correct 100 multiplied by 1 minus alpha percentage confidence interval for the population mean of the normal distribution with unknown variance based on the sample size of n is this, with t sub alpha divided by 2 is the value of t such that alpha divided by 2 is the probability remains in the right tail, and where negative t sub alpha 1/2 is the value of t such that alpha divided by 2 or 1/2 alpha of the probability remains in the left tail. For n equals 1 degrees of freedom, here the 90% confidence interval runs from 1.5 subtracted by this, which is equal to 2.76, which is compactly these two numbers. The hypothesized value of the mean return 1.1 falls within the confidence interval, and we see from the perspective also that the null hypothesis is not rejected at a 10% level of significance. We conclude that the 24-month observed data series notes that 10% is a relatively high probability of rejecting the hypothesis of a 1.1% population mean monthly return when it is true. Example 2, a slowdown in payment of receivables. Fashion Design, a supplier of casual clothing to retail chains, is concerned about a possible slowdown in payments from its customers. The controller's office measures the rate of payment by the average number of days in receivable. Fashion Design has generally maintained an average of 45 days in receivable because it would be too costly to analyze all the company's receivables frequently. The controller's office used sampling to track customers' payment rates. A random sample of 50 accounts shows a mean number of days in receivable of 49 with a standard deviation of 8 days. Formulate no and alternative hypothesis consistent with determining whether the evidence supports the suspected condition that customers' payment has slowed. Identify the test statistic for conducting a test of the hypothesis in part 1. Identify the rejection point of points for a hypothesis testing in part 1 at 0.05 and 0.1 levels of significance. Determine whether the null hypothesis is rejected or not rejected at a 0.5 and a 0.01 levels of significance. Solution to 1. The suspected condition is that the number of days in receivable has increased relative to the historical rate of 45 days, which suggests a greater than alternative hypothesis. With mu as the population mean number of days receivable, the hypotheses are the null hypothesis is when mu is lesser or equal to 45 versus the hypothesis alpha where mu is greater than 45. Solution to 2, because the population variance is not known, we use the t-test with 50 minus 1 equals 49 degrees of freedom. Solution to 3, the rejection point is found across the row of degrees of freedom of 49. To find one-tailed rejection point of a 0.005 significance level, we use the 0.05 column, the value of 1.677 to find one tailored rejection point for a 0.01 level of significance. We use the 0.01 column, the value of 2.405. To summarize, at a 0.05 significance level, we reject the no if we find that t is greater than 1.677. At the 0.01 significance level, we reject the no if we find that t is greater than 2.405. Solution to 4, t49 equals 49 minus 45 divided by 8 divided by square root of 50 equals 3.536. Because 3.536 is greater than 1.677 and no hypothesis is rejected at the 0.5 level. Because 0.365 is greater still than 2.405, then no hypothesis is also rejected at the 0.01 level. We could say with a high level of confidence that Fashion Design has experienced a slowdown in customer payment. The level of significance 0.1 is relatively low probability of rejecting the hypothesis mean of 45 days or less. Rejection gives us confidence that the mean has increased above 45 days. We stated above that when population variance is not known, we use the t-test for tests concerning a single population mean. Given at least approximately normal, the t-test is always called for when we deal with small samples and do not know the population variance. For large samples, the central limit theorem states that the sample mean is approximately normally distributed, whether the distribution of the population. So the t-test is still appropriate, but an alternative test may be more useful when sample size is large. For value samples, practitioners sometimes use a z-test in place of a t-test for tests concerning a mean. The justification for using a z-test is this context is twofold. First, in large samples, the sample mean should follow the normal distribution, at least approximately, as we have already stated. Fulfilling the normality assumption of the z-test. Second, the difference between the rejection points for t-test and z-test becomes quite small when a sample size is large. For a two-sided test at 0.05 level of significance, the rejection point for a z-test are 1.96 and negative 1.96. For a t-test, the rejection points are 2.045 and 0.2.045, or with the DF of 50, about 2.5% difference between a Z and a rejection point. Okay, the Z-test alternative. If the population sample is normally distributed with the known variance of standard deviation squared, then the test statistic for a hypothesis test concerning a single population mean is mu, which is like this. Rejection points for Z-tests, they look like that. Example 3. Okay, so pause the video if you guys want to see that. If not, then let's go on to example 3. The effect of control deficiency disclosure under the Sarbanes-Oxley Act on share prices. The Sarbanes-Oxley Act came into effect in 2002 and introduced major changes to the regulation of corporate governance and financial practice in the United States. One of the requirements of the act is for firms to periodically assess and report certain types of internal control deficiencies, and the audit committee external auditors to the Securities and Exchange Commission, or the SEC. When a company makes an internal control weakness disclosure, does it convey information that affects the market value of the firm's stock? Gupta and Nayar addresses these questions by studying the number of volunteer disclosures made in the very early days of Sarbanes-Oxley in control deficiency disclosures to the SEC from March of 2003 to July 2004. This 90 firm sample was termed the full sample. These firms were further examined to see if there were any other contemporaneous announcements, such as earning announcements associated with the control deficiency disclosure of the 90 firms. 45 did not have any such confounding announcements, and a sample of these firms were termed the clean sample. The announcement day of the internal control weakness was designated T equals 0 if the announcement provides new information useful for the valuation. The information should be caused the stock price to have a return once it exceeds of the prediction given a stock market rise or beta. Called by abnormal returns, significant negative, positive, abnormal returns indicate that investors perceive unfavorable or favorable corporate news in the internal control weakness announcement. Although Gupta and Nayar examined abnormal returns for various time horizons or event windows, we report a solution of their findings for the window 0 and +1, which includes a 2-day period of the day and of the day after the announcement. The researchers chose to use z-test for the statistical significance. For sample 90 firms, the null hypothesis that the average of abnormal stock return during the 0 and +1 was 0 would be true if stock investors did not find either positive or negative information in the announcement. Mean abnormal return of negative 3.07%. Z statistic for abnormal return of negative 5.938. A clean sample of 45 firms. The null hypothesis that the average abnormal stock return during the 0 and +1 was 0 would be true if stock investors did not find either positive or negative information in the announcement. Mean abnormal return is this. Z statistic of abnormal return is this. With respect to both of the cases, support that the null hypothesis reflects the belief that the investor do not, on average, perceive either positive or negative information in control deficiency disclosures. state one set of hypothesis, a null hypothesis, and an alternative hypothesis that covers both cases. Determine whether the null hypothesis formulated in part 1 is rejected or not rejected at 0.05 and 0.01 levels of significance. For the full sample case, interpret the results. Determine whether the null hypothesis formulating in part 1 is rejected or not rejected at the 0.05 and 0.01 level of significance. For the clean sample case, interpret the results. Solution to 1. A set of hypotheses consists with no information in control deficiency disclosures relevant to the stock investor. No hypothesis is the population mean abnormal return during 0 and plus 1 equals 0. The alternative hypothesis is the population mean abnormal return is 0, does not equal 0. Solution to 2. From the information on rejection points of z-test, we know that we reject the null hypothesis of 0.05 significance levels if z is greater than 1.96, or if z is lesser than negative 1.96, and at the 0.01 significance level if z is greater than 2.525, or if z is lesser than 2.575. The z statistic reported by the researcher is negative 5.938, which is significant at the 0.05 and 0.01 levels. The null is rejected. The control deficiency disclosure appears to contain valuation relevant information because it is possible for significant results could be due to outliers. The researchers also reported a number of cases of positive and negative abnormal returns. The ratio of cases of positive to negative abnormal return was 32.58, which tends to support the conclusion from the z-test of statistically significant negative abnormal returns. Solution to 3. The z statistic reported by the researchers for a clean sample is negative 3.359, which is significant to the 0.05 and 0.01 level. Although both the mean abnormal return and a z statistic are smaller in magnitude for the clean sample, for the clean sample than for the full sample, the results continue to be satisfactorily significant. The ratio of cases of positive to negative abnormal returns were 16.29, which tends to support the conclusion from the z-test of statistically significant negative abnormal returns. Nearly all practical solutions involves an unknown population variance. Table 2 summarizes our discussion of tests concerning the population mean with the population variance when the population variance is unknown. Table 2, that's what it looks like. 3.2 tests concerning difference between means. We often want to know whether a mean value, for example, a mean value return difference between two groups. It is observed difference due to the chance or to different underlying We discussed two t-tests for a test concerning difference between the means and two populations. In other case, the population variance, although unknown, can be assumed to be equal. Then we effectively combine the observation from both samples to obtain a pooled estimate of the combined but unknown population variance. A pooled estimate is an estimate down from the combination of two-level samples. In the second case, we do not assume the unknown population variance are equal, and an approximate t-test is then available, letting mu1 and mu2 stand respectively for whether the population mean of the first and second population. We must often want to test whether the population mean, although unknown, are equal or whether one is larger than the other. Thus, we usually formulate the following hypothesis. Okay, so here's just the hypothesis. Example 4, mean return for the S&P 500 test equality across two halves of a decade. The realized mean monthly return of the S&P 500 index is the first half of the 2000s appears to have been substantially different than the mean return in the second half of the 2000s. Was the difference statistically significant? The data shown in Table 3 indicates that assuming equal population variance for returns in the two periods is not unreasonable. Formulate no. So what you want to do here is to formulate null and alternative hypothesis. Consists with a two-sided hypothesis test. Identify the test statistic for conducting a test of the hypothesis in part 1. The 0.1 and 0.05 and 0.01 levels of significance. Determine whether the null hypothesis is rejected or not rejected at the 0.1, 0.05, and 0.01 level of significance 0. Solution to 1, letting mu stand for the population mean return for 2000 through 2004, and mu 2 stand for the population mean return for 2005 through 2009. We formulate the following hypothesis. The null hypothesis is equal to the mu 1 subtracted by mu 2 versus the alternative hypothesis mu 1 subtracted by mu 2 doesn't equal 0. But the first one is equal to 0. Solution to 2, because the two samples are drawn from two different time periods, they are independent samples. The population variance is not known but can be assumed to be equal. Given all these considerations, the t-test given in equation 7 has 60 plus 60 minus 2, which is 118 degrees of freedom. Solution to 3 in the table, Appendix B, the closest number of degrees of freedom is 118, and 112 is 112 for a two-sided test. The rejection point is this. So yeah. Solution to 4, calculating the test statistic, you literally just plug it in. In many cases of practical interest, we cannot assume that population variance are equal. The following test statistic is often used in the investment literature. In such case, test statistic for a test of the difference between the two population means normally distributed population unequal the unknown population variance. But we can assume that the two populations are normally distributed but not known to the population variance, and cannot assume that they are equal. An appropriate t-test based on independent random samples is given by this, where we use tables of the t distribution using the modified degree of finance computed with the formulas. A practical tie-up is to A practical tip is to compute the t statistic before computing the degrees of freedom. Whether or not the t statistic is significant will sometimes be obvious. Example 5, recovery rates on default bonds, a hypothesis test. So yeah, it shouldn't be too hard, just quite straightforward. You can pause the video if you have more questions. Okay, 3.3, tests concerning mean difference. In the previous section, we presented 2 tests for our discerning differences between populations mean. The tests were based on 2 samples. An assumption for those tests' validity was that the sample was independent, i.e. unrelated to each other. When we want to conduct tests on 2 mean based on samples that we believe are independent, the method of this section applies. The t-test in this section is based on data arranged by paired observations. And a test itself is sometimes called the paired comparison test. Paired comparisons are comparison tests in a statistic test for differences in dependent items. For example, in the tax law affecting the taxation of dividends, we then have a pair of before and after observations for the same company. For the same companies, we may test a hypothesis before the mean of the difference, mean difference that we observe across the companies. In other cases, the paired observations are not on the same unit. For example, we may be testing whether the mean return earned by two investment strategies will equal over a standard period. This observation here are dependent in the sense that it is not one observation for each strategy in each month, but both observations depend on underlying market risk factors, because the return is both to both strategies are likely to be related to some common risk factors, such as the market return. The samples are dependent by calculating a sample error based on difference. The t-test presented below takes account of a correlation between the observations. Let A represent the after and B before. Suppose we have observations for the random variable xa and xb, and the sample are dependent. We arrange the observations in pairs. Let D1 denotes D sub I denote the difference between the two pairs observations. Okay. Yeah, so that's it. All right, so that's part 3 of level 1 program curriculum, reading 12? I think it's 12. So level 1, part 3, reading 12. I hope to see you guys in the next video. Without further ado, goodbye.
Okay, continued reading of the CFA level 1 program curriculum. Reading 12, part 4, hypothesis test concerning variance. Because variance and standard deviations are widely used quantitative measures of risk, an investment analyst should be familiar with hypothesis tests concerning variance. The tests discussed in this section make regular appearance in investment literature. We examine two types: tests concerning the variance, the value of a single population variance, and tests concerning the difference between two population variance. 4.1 test concerning a single variance. In this section, we discuss testing hypothesis about the variance of the value of standard deviation squared of a single population. We use standard deviation 0 squared to denote the hypothesis valued of standard deviation squared. We can formulate hypothesis as followed. As we can see right here, the test concerning the variance of a single normally distributed population, we make the chi-squared test statistic denoted as x squared. The chi-squared distribution, unlike the normal and t distribution, is asymmetrical. Like the t distribution, the chi-squared distribution is a family of distributions. A different distribution exists for each possible value of degree of freedom. n-1, n is a sample size. Unlike the t distribution, the chi-squared distribution is bounded below the 0. X squared does not take a negative value. The t statistic for the test concerning the value of a population variance or the normal population when n is -1 degrees of freedom, in this in the numerator of expression is the sample variance calculated as such. In contrast, the t-test, for example, the chi-squared test, is sensitive to violations of this assumption if the sample is not actually random, or if it does not come from a normally distributed population. Inference based on the chi-squared test are likely to be faulty. If we choose a level of significance A or alpha, and the rejection point of 3 kinds of hypotheses are as followed. 1, rejection point of hypothesis on the population variance, not equal to the alternative hypothesis. A rejected null hypothesis, if the test statistic is greater than or upward than the alpha divided by 2 points, denoted as such, greater than this value or lesser than the other value. Example 7, risk and return characteristics of an equity mutual fund. You can continue your answer of the standard equity fund, a mid-cap growth fund that has been in existence for only 24 months. Recall that during this period, standard equity
achieve the sample standard deviation of monthly return of 3.6%. And now you want to test a claim that the particular investment discipline follows the standard result in standard deviation of monthly returns of less than 4%. Formulate no and alternative hypothesis consisting of the verbal descriptions of the research goal. Identify the test statistic for conducting a test of the hypothesis. For part 1, identify the rejection point or points for the hypothesis tested in part 1 at the 0.05 level of significance. Determine whether the null hypothesis is rejected or not rejected at the 0.05 level of significance. Solution to 1, we have the less than alternative hypothesis when standard deviation is underlying standard deviation, the return of the slender equity fund, being careful to square standard deviation to obtain the test of the terms and variance. The hypothesis of the alternative or the no hypothesis is as such, which is equal to 16.0. Solution to 2, the test statistic of x squared with 41 minus 1 is 23 degrees of freedom. Solution to 3, the lower 0.05 rejects point is founded on the line of df equals 23 under the 0.95 column. 95% probability in the right tail to give 0.95 probability of getting the test statistic is larger or large. The rejection point at 13.091, we will reject the no if we find that x squared is less than 13.091. Solution to 4, as such, because 18.63 is the calculated value of the test statistic, is not less than 13.091. We do not reject the no hypothesis. We cannot conclude that Slender's investment discipline results in a standard deviation of a monthly return of less than 4%. Tests concerning the equity or inequality of two variances. Suppose we have a hypothesis about a relative value of the variance of two normally distributed populations with a mean of mu1 and mu2. The variance of variance 1 and variance 2. We can formulate the hypothesis as one of the choice below. As such, note that at the point of equality, the null hypothesis of the variance 1 equals variance 2 equals implies that the ratio of population variance equals 1, given that this condition is true. Given independent random samples of these populations, tests related to these hypotheses are based on the f-test, which is the ratio of sample variance. Suppose we use n1 to observations in calculating the sample variance of S1 standard deviation squared and n2 observations in the calculations of the sample variance. Tests concerning the difference between the variance of two populations must use the F distribution. Like the chi-square distribution, the F distribution is a family of asymmetrical distributions bounded by below by 0. Each F distribution is defined by two values of degrees of freedom called the numerator and denominator degree of freedom. The F test, like the chi-square test, is not robust to violations of its assumptions. Test statistic for tests concerning differences between the variance of two populations, normally distributed populations. Suppose we have two samples, the first with n1 observations and sample variance squared. The second with n2 and sample variance of sample variance 2 squared. The samples are random, independent of each other, and generate and a test concerning the difference between the variances of the two populations is based on the ratio sample variance. With this numerator degrees of freedom and this as the denominator of degrees of freedom. Note that the F1 and the F2 are the divisors using calculating the S1 2. Yeah. Okay, so this is just a example. Reading 12, part 5, other issues, non-parametric inference. The hypothesis testing procedures we have discussed to this point have two characteristics in common. First, they are concerned with parameters, and second, their validity depends on a definite set of assumptions. Mean and variance, for example, are two parameters that defining quantities of normal distributions. The tests also make specific assumptions in particular assumptions about the distribution of the population producing the sample. Any test or procedures with either the above two characteristics is a parametric test or procedure. In some cases, however, we are concerned about quantities, other parameters of distribution. In other cases, we may believe that the assumptions of parameter tests do not hold for the we primarily use non-parametric procedures in three situations: when the data we use do not meet distribution assumptions, when the data are given in rank, or when the hypothesis we are addressing does not concern parameter. The first situation occurs when data available for analysis suggests that the distribution assumption of the parametric test is not satisfied. For example, we may not want to test hypothesis concerning the mean of the population, believe that neither z-test nor t-test or z-test is appropriate because the sample is small and may come from a markedly non-normally distributed population. In that case, we may use observation or a function of observations into ranks according to magnitude, and sometimes it will involve working with only greater than or less than relationships, using the sign plus and minus to denote these relationships. Characteristically, one must refer, at least for small samples, such tests that typically interpret the null hypothesis as a thesis about rank or signals or signs. In Table 9, we give examples of non-parametric alternative to the parametric test we have discussed in this reading. The reader should consult a comprehensive business statistic textbook for an introduction of such tests and a specialist textbook for details. Table 9, non-parametric alternatives to parameter tests. We pointed out that when we use non-parametric tests, we often convert the original data into ranks. In some cases, the original data are already ranked. In these cases, we also use non-parametric tests because parametric tests generally require a stronger measurement scale than rank. For example, if our data were the rankings of investment managers, hypotheses concerning these rankings would be tested using non-parametric procedures. Ranking data also appears in many other finance contexts. For example, Hane, Koga, Oliver, and Tran in 1999 studied the relationship between the size of Japanese companies as measured by revenue and the use of derivatives. The company's study used derivatives to hedge one or more of 5 types of risk exposures: interest rate risk, foreign exchange risk, commodity price risks, market securities price risks, and credit risks. The researchers gave a perceived scope of risk exposure, scoring each company that was equal to the number of types of exposure of the company reported hedging. Although revenue is measured on a strong scale, a ratio scale, scope of risk exposure is measured in only one ordinal scale. The researchers thus employed non-parametric statistics to explore the relationship between derivatives usage and size. The third situation in which we use non-parametric procedure occurs when our question does not concern a parameter. For example, if a question concerns whether a sample size is random or not, we use the appropriate non-parametric tests. A so-called run test, another type of question non-parametric can address, is whether a sample comes from a population following a particular probability distribution, using the Kolmogorov or Simitrov test. For example, the end is reading by describing in some detail a non-parametric statistic that is often being used in investment research and Spearman rank correlation. 5.1 test concerning correlation, the Spearman rank correlation coefficient. In many contexts in investment, we will want to assess the strength of the linear relationship between two variables, the correlation between them. In a majority of cases, we use the correlation coefficient described in the reading on probability concepts and correlation correlation and regression. However, the t-test and the hypothesis that two variables are uncorrelated based on the correlation coefficient relies on fairness stringent assumptions. When we believe that the population under consideration meaningfully departs from these assumptions, we can employ a test based on the Spearman rank correlation coefficient. The Spearman rank correlation coefficient is essentially equivalent to the usual correlation coefficient. The rank of two variables, say x and y, within their respective samples. Thus, the numbers between -1 and +1, when -1 and +1 denotes a perfect inverse positive straight line relationship between the variables, and 0 represents the absence of any straight line. Rank the observations of y from largest to smallest. Assign the number of 1 to the observations with the largest value, the number 2 to the observations with the second largest values, and so on. In case of tie, we assign each tie observations to the average of the ranks under jointly occupied. For example, if the third and fourth largest values are tied, we assign both observations and rank to calculate the difference between the between the numbers. Okay, suppose an investor wants to invest in a diversified earnings market mutual fund. He has narrowed the field to 10 such funds, which are largest in terms of total net assets. In examining the fund, a question arises as whether the fund almost reports Sharpe ratios or expenses ratios as mid-2013 are related, because the assumptions of the t-test and the correlation coefficient may not be met. It is appropriate to conduct a test on the rank of the coefficient. In the example at hand, the two-tailed test, the 0.05 significance level, table 11 gives the upper tail rejection point for n equals 10 as 0.6, and we do not reject this null hypothesis. In the mutual fund example, we convert observations on two variables into ranks. If one or both of the original variables were in the form of ranks, we would need to use RS to investigate correlation. 5.2 non-parametric inference summary. Non-parametric statistical procedures extend the reach of inference because they make few assumptions, can be used to rank data, and may address questions unrelated to parameters. Quite frequently, non-parametric tests are reported alongside parametric tests. The readers can assess how sensitive and statistical conclusions is to the assumptions underlying the parameter test. However, the assumptions of the parametric tests are met. The parametric test, when available, is generally preferred to the non-parametric test because the parametric test usually permits us to draw sharper conclusions. Okay, summary. In this reading, we have presented the concepts and methods of statistical interference and hypothesis testing. A hypothesis is a statement about one or more populations. The steps in testing a hypothesis are as followed. 1. State the hypothesis. 2. Identify the appropriate test statistic in the probability distribution. 3. Specify the significance level. 4. Stating the decision rule. 5. Collecting the data and calculating the test statistic. 6. Making statistical decisions. 7. Making economic or investment decisions. We state two hypotheses. The null hypothesis is the hypothesis to be tested. The alternative hypothesis is the hypothesis to accept when the null hypothesis is rejected. There are 3 ways to formulate hypothesis. These are the three ways. When theta zero is or theta sub zero is hypothesized value of the population parameter. Theta is the true value of the population parameter. If the above formulation 1 is a two-sided test, the formulation 1 and 2 are one-sided tests. When we have a suspected or hoped for condition for which we want to find supportive evidence, we frequently set up conditions as the alternative hypothesis and use one-sided tests to emphasize a neutral aptitude. However, the researcher may select a non-equal to alternative hypothesis and conduct a two-sided test. A statistic is a quantity calculated on the basis of a sample whose value is the basis for deciding whether to reject or not reject a null hypothesis. To decide whether to reject or reject the null hypothesis, we compare the computed values of the test statistics to a crucial value rejection point of the sample test statistic. In researching a statistical decision, we make two possible errors. We may reject a true null hypothesis, it's a type 1 error. We may fail to reject a false null hypothesis, which is a type 2 error. The levels of significance of a test is the hypothesis of a test 1, of a type 1 error that we accept in conducting a hypothesis test. The probability of a type 1 error is denoted as the Greek letter alpha. The standard approach to hypothesis testing involves specifying a level of significance, which is the probability of a type 1 error only. The power of a test is the probability of correctly rejecting the no hypothesis, rejecting the no when it is false. A decision rule consists of determining the rejection points, which are the critical values with which we compare the test statistics to decide whether to reject or not to reject the null hypothesis. When we reject the null hypothesis, the result is said to be statistically significant. A 1 minus alpha confidence intervals represents the ranges values of statistics, which will be the null hypothesis not rejected. At the alpha significance level, the statistical decision consists of rejecting or not rejecting the null hypothesis. The economic decisions takes into consideration all economic issues pertinent in the decisions. The p-value is the smallest level of significance at which the null hypothesis can be rejected. The smaller the p-value, the stronger the evidence against the null hypothesis and in favor of the alternative hypothesis. The p-value approaches to hypothesis testing does not involve setting a significance level. Rather, it involves computing the p-values for a test statistic and allowing the consumer of the research to interpret its significance. For hypothesis tests concerning the population mean of a normally distributed population with unknown or known variances, the theoretically correct test statistic is the t statistic or the z statistic. In the unknown variance case, given large samples, generally sample of 30 or more observations, the z statistic may be used in place of the t statistic because of the force of the central limit theorem. The t distribution is a symmetrical distribution defined by a single parameter, degrees of freedom. Compared to the standard normal distribution, the t distribution has factor tails. When we want to test whether the observed difference between two means is statistically significant, we must first decide whether the samples are independent or dependent or related. If the samples are independent, we conduct tests concerning differences between means. If the samples are dependent, we conduct tests of means differences or pair comparison tests. When we conduct a test of the difference between two population means from the normally distributed population with unknown variances, if we can assume the variances are equal, we use a t-test based on pooling and the observations of the two samples to estimate the common or the but unknown variances. The tests are based on the assumptions of independent samples. When we conduct a test of difference between two population means from the normally distributed populations with unknown variances, if we cannot assume that the variance is not equal, we use an approximate t-test using modified degrees of freedom given by a formula. This test is based on an assumption of independent samples, and tests concerning two means based on two samples that are not independent. We often can arrange the data in paired observations and conduct a test of mean differences, a pair comparison test. When the samples are form normally distributed populations with unknown variances, the appropriate test statistic is a t-statistic. The denominator of the t-statistic and standard error of the mean differences that takes account of correlation between the samples. In tests concerning two mean based on the two samples that are not independent, we often can arrange the data in paired observations and conduct a test of mean differences, a pair comparison test. When the samples are form normally distributed populations with unknown variances, the appropriate test statistic is a t-statistic. The denominator of the t-statistic, the standard error of the mean difference, takes account of correlation between the samples. In tests concerning the variance of a single normally distributed population, the test statistic is chi squared or x squared, with n-1 degrees of freedom, where n is the sample size. The test concerning difference between the variance and two normally distributed population based on two random independent samples, the appropriate test statistic is based on the f-test, the ratio of the sample variance. The f-statistic is defined by the numerator of the denominator's degrees of freedom. The numerator degrees of freedom, number of observations in the sample minus 1, is the divisor used in calculating the sample variance, and the numerator of the denominator degrees of freedoms, numbers of observations in the sample minus 1, is the divisor used in calculating the sample variance in a denominator, and forming the f-test convention is to use the larger of the two ratios at the actual test statistic. A parametric test is a hypothesis test concerning a parameter or a hypothesis test based on specific distribution, show no assumption. In contrast, a non-parametric test either is not concerned with the parameter or makes minimal assumptions about the populations from which the sample comes. A non-parametric test is primarily used in three situations: when data do not meet distribution assumptions, when data are given in ranks, or when the hypothesis we are addressing does not concern a parameter. The Spearman rank correlation coefficient is calculated on the rank of two variables within their respective samples. Okay, so that is reading 12 in the quantitative analysis section. Our next section is going to be on technical analysis, and then we're going to finish this book. We're going to finish this first section of the book, which is ethics and professional conduct and quantitative analysis. So we have one more reading left, which is a few more readings, which is technical analysis. I hope these readings have been helpful, and I hope to see you guys in our next reading. We'll be going over technical analysis starting from reading 13. Without further ado, goodbye.